Hello, everyone. Mike Arnold here, co-founder Path Trading Partners, along with Bob Iacchino. How is everyone doing? Good morning, Tesla Force. Good morning, Christoph. How is everything over in Europe? Ted, yes, here we go. CPI numbers. CPI numbers. Let's see. Options 22. Can do analysis on NOV? Your best guess on when it could hit the top of the double top trigger? Uh, I can look at it. Sure. Let's see. We already had a core inflation. Good morning, Wavy. Core inflation coming in 6.4 as expected. Inflation rate year over year coming in at 7.9 as expected. And then we have the monthly, month over month, 0.5 and 0.8. Everything coming in as expected. Initial jobless claims slightly higher than forecast, but not bad. Continuing jobless claims slightly higher than forecast. What do we have next on the agenda? Let's see. We have the Fed quarterly financial accounts and monthly budget statement, but nothing much today else coming out that's going to move stuff. We already have the inflation figures coming out. FOMC Fed Watch tool. I refreshed this before, but we'll take a quick look at it again. And while I'm waiting for that, by the way, if you are new here, please do consider subscribing, ringing that bell, and hitting the like button. Longer term viewers, please do leave some comments and hit that hit the like button. I can't even think. There's a lot going on this morning. All right, the Fed watch. There's definitely a rate hike. It's going to be 25 basis point hike. That's just where it is. By the way, I got asked a question where I get my gamma information because we're still in negative gamma territory. But if you want a little thing, you can sign up for Tier 1 Alpha. I think there's some free stuff up here too. Tier 1 Alpha. Tier1alpha.com, and you can start to see where the gamma flip is. So right now it says right around 4,400. It's slightly higher. It was like 4,406. Yeah. So that's where I'll be watching. Now remember, negative gamma leads to more and more volatility in the market. So good morning, Sashi. CPI is expected, but still very high. Yeah, I'm not saying that's minimizing in anything. But this is inflation without a 20% increase in oil. Yeah, the next ones are going to be, it's going to get real interesting. Yep, next month's going to be much worse. But this, I'm just saying, is coming in as expected. 7.9 inflation year over year is horrible. Horrible. We may be seeing a prop play falling apart from yesterday as we are under yesterday's open in an air market. No strength with no prop. So we will see ECB announced phasing asset purchase program 40 billion per month in April to 20 in June. Not more details. Only afterwards would hike rates. Still quite dovish. Still, I think EU in trouble long term. Well, did you see the Italian PPI numbers? Here you go. Month over month, January, previous 1.1 actual came in 9.7, year over year 32.9. So ECB is losing all credibility, even more so than the Fed. And I think our Fed is losing credibility, but just going with 25 basis points next week. Let's take a look at the markets, though. You got to trade what is. Yes, we may be seeing a little, you are into a clear path move. We had that little double from last night. Again, we triggered the longer-term double bottom. Even with this pullback, that double is still in play. We had that little double top, which pulled back, pausing there, and now through it. So, again, this is not over. These doubles that triggered yesterday on the 4-hour are not over. Like the S&P one isn't over till about 41.72. So, can this pullback be traded to the long side? Yeah, you even have trading right below this key support, this key critical level for me, 42.23. Next area I'm watching is about 41.95 to 41.90. And then below that, it would be that 41.72 area, which would invalidate the double. To the upside, remember the probabilities, I got to trade the probabilities, and the probabilities say we could still have another pop higher. But if there's increased selling pressure, I will go with that throughout the day until the double's invalidated, but I will watch for reversal patterns. 42.54 to the upside, again, is my first level of resistance. You can see here slicing through there, trying to retest. And now we got the rollover rotation zone on the 1 hour, but 42 would go 42.55. Above there, I'd target 42.86. And then yesterday's highs. Nothing else changes with those targets from the upside. The minor ones I'll be using is 41.38 should we rally, and I'm not expecting that fully today unless we have a major reversal move. But you can put these down on your charts should it break through yesterday's high. Then 43.38. I'm not even targeting the full doubles at this point. If we do rally, I'm targeting this 43.39, 43.40. Wavy's coming in 42 below 4,200 is the danger zone, and I'm at 41.93. Yeah, you could even go to. I'd probably go to 41.97, and we could fine tune those levels. But there is, if you use your volume profile, there's a lot of area down here that you can go into a really nice pocket. And you see here, even on the 1 hour, you have a clear path move, and you're down to this 41.93 area. Let's get through the rest of the markets. NASDAQ. And remember, longer term, we're still in the rotation zones. So not surprising to see a rotation lower. Let me jump back to that S&P. You can see here that first target is roughly at the top. So if we do make another pop back up, that's my key area. Watch that on the S&P. Watch that on the NASDAQ. But right now with the NASDAQ, again, moving down into the clear path move. Next target lower is 13,350 area. You even see that on the 1 hour. We're sitting right at this little pausing shelf. So about 13,515, 13,500, we start going down there, then I could watch for the accelerating move down. Because here's the little pausing area. That's where you fine tune it going. We have the clear path on the longer term, fine tune it on the shorter term, and it's sitting right at that stopping point, but then we don't really have any 1 hour stopping points till down here to this 13,350 area. To the upside, with this stalling out yesterday at the harmonic, the 25% harmonic. So again, if it does pop back up at some point, the next minor area we'd target 13,911, 13,947, then major target would be 13,996. So that's everything, but short term, I'm seeing if it can get above 13,591. Can't get bullish at all, even with this pattern, until it pops back above 13,591. Hold on 1 second, 1 second, 1 second. I was seeing if Bob was going to jump on. Dow. Dow, again, we have that double pattern. To the bottom too, you see that double right here, and coming back down, briefly pausing at that final target, and then rolling over again. You actually still now have a technical little short-term double bottom here that I got to keep an eye out for on the open. So I will be watching this little play on the Dow off the open. Didn't go down the shorter-term charts. There might be one on S&P and NAS. I'll have to pop back over there. My first little area I'll be watching is to see if it can regain about 32,925, and then 33, essentially 33,014 would trigger the double, and that would just be on a little run up to 33,169. Against trading against key support, just breaking there now. But let's take a look at those longer term charts. Not much of a move down here, but if it pops below 32,779, or that's going to be the next key support. And to invalidate this double pop pattern, we'd have to get down to about 32,529. It looks like Bob can jump on. Hold on. Hold on, everyone. Get back to the main camera. Unlock that. There we go. And
what's up, guys?
How is everyone doing? We got Bob in the house. And look, you got double mics. You got double mic. There we go. Double mic is gone. Single mic. How you doing, Bob?
Good.
What do you think with the CPI?
Just tweeted it out. Most important thing in this to me. Real wages year over year, average hourly real wages down 2.6%. So if you are an equity investor, you fit within that sort of down 2.6% real wages, guess what you're going to buy less of? Everything. Guess what you're going to have less free money for? Stock investing.
What about my electric car? Because I should just run out and buy
According
an
to Pete
electric car.
Buttigieg, you should just go get one.
Yep. So can I buy the same electric car even if real wages are down?
According to Steve, what's that guy's name? I don't watch late night TV. Colbert, Stephen Colbert. Yeah, we should be willing to pay $15 a gallon or just buy a Tesla.
But where do we get our electricity from?
Exactly. They're such idiots.
Don't we still have to, aren't electricity rates going to go up too? I mean,
yeah,
they
actually are going up. Coal prices are not down.
I mean, I just don't know what to say to these people. But we're going to tax aren't we going to tax potentially the oil companies even more from their windfill war profits?
Oh God! So remember, when was it on Tuesday? I was in a Twitter fight. I could not get people to understand that the screaming about record profits for the oil companies is just nonsensical. You model your business out 6 to 12 months, sometimes further than that, right? And essentially, you have a profit percentage built in. And if your product is selling at $3 and you make 1%, then you make 3 cents. If your product is priced at $6 and you make 1%, then you make 6 cents. It's still 1%. And people want the oil companies to go, whoa, record profits. Let's cut our percentage profit down to 0.5%, right? Let's just hurry up and do that. Even though WTI prices went up 77% in 14 days. Mike, you've been trading longer than me. When something goes up 70%, 77% in 14 days, what does that tell you about the downside potential?
There's a huge downside potential.
Huge. It could go down 70% in 5 days. And then all of a sudden they got to go, whoa. We got to up our prices, even though prices are going down. It's nonsensical to say that kind of thing when a move happens this quickly. If oil companies are making profits, record profits year after year after year for 10 years, I will listen to Elizabeth Warren about price gouging. And I'm talking about regardless of crude oil price. And then I will listen to Elizabeth Warren about price gouging. But until then, I'm sorry, man, when prices were down at $20, when prices went negative and nobody was buying energy stocks and companies like Exxon and all that, we're talking about cost cutting and all this. Nobody wanted to come to their rescue. By the way, I don't think there should be oil company subsidies for anyone who's watching this that isn't in the room with us now, that are always big supporters that watch us live. But I'm just saying, I don't think there should be oil company subsidies. However, when you say that because there's inflation in energy and all of a sudden they're making record profits, same thing's happening in food, right? I mean, these food companies are recording record profits because food prices are up and their model hasn't changed. Although in a lot of cases, there's been supply disruptions, so some of that isn't making its way through. Anyway, that's the most important part to me is real wages down 2.6% year over year.
Well, there you go. And crude pulled back, hit the second target on the double top, bounced off the second target yesterday. Still watching to see if it's going to roll over and hit that third target. By the way, we got a request for NOV. NOV again. We look at this double pattern on this thing.
Yeah.
And it hit the second target. That's all longer term. Again, when could it hit the third target was the question. I'd just be watching to see either with the sideways move once some of these rotation zones starts catching up. I'd watch for the next push. Like we're sitting right here at the 4 hour, so we could make another run higher. But if that crude pulls back again to hit that final double target, then it might take until like next week or something, or even slightly longer than that. Again,
By the way, I'm
timing on
sorry.
these, what?
Go ahead. No, keep going.
Timing on the timing is really tough because you hit the first second target right away, and we could easily still pull back to this. This is a longer term trade. Remember, it was a massive double bottom that look how long it took to even get to the, and then it just rocketed to the first second target. So if oil rebounds real quick off that second double bottom target, then yeah, I could see the push up there now. If oil stays in this trading range, it's going to take longer for this to push higher.
So, by the way, this was what I was going to say about NOV, which is obviously a oil and gas equipment maker, right? Was This is a great example of, there's plenty of times where Mike and I in Stock Think Tank or one of the other things we may do, whether it's a webinar or something, we talk about a stock and it'll just go sideways for a while and people will say, why are we still holding on to this? And we'll say, pattern's not invalidated. I mean, in Stock Think Tank, I think our average hold time is still around 26 or 27 days. But we've had stocks that we've gotten out of in a week, and we've held PHYS since July of last year. So, yeah, it's just a matter of the pattern playing out. And it either the pattern gets invalidated and you get out, or the pattern does not get invalidated and you stay in. And that's the money you allocated to this particular pattern because of probabilities and not because of anything else.
Yeah, and here's the pattern on gold. You see here, triggered that double top, coming down first, second, third targets all hit. So that pattern was over.
Yeah, fast.
And now what do we have? We have this little, I'm just keeping an eye on this sloppy double bottom down here, but that gives some nice rebound targets of 2027 and 2041. So that's where you just have to, again, a trade can be wrong, but that was just like we had a discussion yesterday afternoon because I said we had these doubles on things like the S&P, and everybody's saying inflation. And you could pull back here, but we could still move higher based off the probabilities. Now, if this comes down and goes to new lows, yeah, it was one of those 30%. That's wrong. But what do you trade with? If I can't trade with probabilities, I don't know what to trade with. Because do I just trade with what I think's going to happen? I mean, how do you do it? Well, you did a lot of research, Bob, right?
Yeah.
Before we even worked together. How did
Yeah.
when you did your research, did you take into account and go back and analyze what everybody thought the number was going to print, and then you
No.
invalidated a pattern or probabilities based off, oh, is inflation going to be low? Is inflation going to be high? Is the Fed going to do this? You based it off of.
Well, this goes back to one of the first conversations Mike and I had when we first met. We sat down privately. We were at a conference, and we sat down privately. And Mike was telling me he learned what I was teaching, and he improved it. And I am very conceited and arrogant, but I'm not so conceited and arrogant as to think that somebody can't improve what I'm doing. Thank God. So, and Mike showed me some of the improvements he made, and I agreed that they were improvements. So we started working together. But one of the first conversations we had is we agreed upon, when you look back at the probability of patterns, I don't even want to use the phrase back testing anymore because people can kind of bastardize that. But when you look back and you say, okay, this Monte Carlo simulations and back testing seems to be about 58% probable. Now, let me go back and take out every non-farm payrolls report. Let me go back and take out every earnings report. Let me go back and take out any day that there was surprise news, which I don't know why you would do that because you can't predict surprise news anyway. You can't do any of that. You take the data that's in front of you. So a lot of people, I've heard people say, well, will you still enter a trade if it's like the day before payrolls or the day before earnings? Earnings, no. But the only time that I adjust a trade prior to an event that's specific to a security, whether it be futures, stocks, whatever, is if I'm near my target. That's it. If I'm near my stop, I don't do it. If I'm near an entry, I might take it out. But not the one that I look at the most. If I'm close to a target, within 80% of a target, I might exit that early. simply because of what the psychology does for me when it does to me personally when I'm near a target and all of a sudden it collapses and stops me out. But I don't have that in my data either. And I suspect if I were to look at that in my data, I'd probably be costing myself money by doing that. But I feel like the idea of it hurting my psychology short term is more important to me. So no, I mean, when we back test stuff, when we research stuff, you're researching the price data that's in front of you, period. You don't go back and look at expectations, what the market thought, because all of that's built into price.
Exactly. So here we have mini double bottoms now. S&P, their potential, but you get above 42, 47, you got a little pop back higher. Even with the inflation numbers, you got one on the Nasdaq. So there's what I'm going to be doing on the open. I'm going to be watching for these key levels. Nasdaq 13 13,622.50. There's your little potential pop. If we get above there, then it can roll into this bigger pattern, which is the potential double or the trigger double that was confirmed on the 4 hour yesterday and actually closed above there. And this pullback doesn't invalidate the pattern. So that's where we sit. Let's see what else. Is there anything else you wanted to cover, Bob? I mean, we're running.
Yeah, I'd like to talk specifically about CPI and then touch a little bit on the ECB. So I actually am about to tweet this out. I haven't done it yet, but the more that I watch central bankers and economists, the more I think that economics shouldn't be a science, shouldn't be classified as a science, and should be classified rather as philosophy. And the reason I say that is because when you listen to Christine Lagarde talk, who is a trained economist, Jerome Powell's not a trained economist, but he was a venture capital, an economist for a venture capital company. So he doesn't come from academia. They're wrong all the time. And they sit there and they say, well, we're data dependent. Sounds a little bit more like medicine, right? Where you try something based on the data that's in front of you, and then you see if it works or not. And if the patient dies, you know you were wrong. If the patient gets better, you know you were right, right? And you take that accumulative experience and apply it to other sets of data. But obviously, things like COVID-19 can happen that never happened before. So this particular CPI hit expectations, right? A lot of market watchers were expecting it to beat expectations. But yet, what do we see in equities? We see weakness, right? We saw it briefly come off the lows and then kind of head back down there. I'm actually going to pull up on my side here a futures chart, a real-time futures chart. And yeah, we're near the lows now of the day. So we got a little bit of a pop and then it's pressuring lower. So why is that? Because people were expecting beats. Mike, I think I Twittered you or texted you that list, right?
Yep.
There was 8.1, 8.0, but there were some as low as 7.7. So I'm listening to Michael McKee, who's the lead economist on Bloomberg, and he says, well, economists got it right. And then I flash back to that range of 7% to 8.1, and I'm like, well, which one got it right? Right? The median forecast.
Here's what you tagged me on.
The median forecast was right. So it wasn't that economists got it right. Some economists got it right. Anyway, when you look at the whole of these numbers, they're so high to begin with that even though the market got it right, the market was pricing in a surprise either way. So you got a little bit of short covering on those that didn't get a higher print. And then you have your sort of real move. And this happens with every big piece of data. It's most noticeable in non-farm. The initial move in non-farm, and Mike, maybe you remember this from your trading floor days, I do. The initial move in non-farm is always position covering, right? Short-term traders that are either taking a profit or getting out when they're wrong. And then the real move develops. 7.9% in the US is brutal, given that this February number did not have the war in it. Okay, so it did not have $114, $115 crude. Where are we now? Crude oil right now is 112.
113.
113. Okay. This CPI number does not have that in there. This CPI does not have wheat price increases, 3 or 4 days of limit up in wheat. It does not have soybean. It does not have corn. It does not have meat prices that have gone up because feed prices have gone up. Does not have, fertilizer prices have gone up. None of that is in here. Okay. It doesn't have rent equivalent owner occupancy from this current month, which has gone up because interest rates have gone up. So there's been more renters rather than buyers. Next month is likely to be as high or worse. And the Fed now needs to go into what is likely a slowing economy. We definitely have asset prices lower on the equity side, and raise rates and justify it. And they have to do it. The reason I wanted to talk about the ECB is Christine Lagarde, in the face of a war that affects her region more than it does the US, got more hawkish. Now she's talking around it, right? She's saying that rates will go up sometime after they finish their asset purchases. They sped up their asset purchases. So the ECB is a little bit different. The ECB has a set amount of assets they're going to purchase. They announced that in the beginning of the asset purchase program. And they adjust the size of the monthly purchases. And that's kind of like how they either extend it or contract the time frame of it. So they've upped it to 40, 30, 20, and then they're going to reassess, right? So they bumped up those asset purchases. To me, that's an acknowledgement of two things. Number one, the short term is scary. Number two, they need to get it finished, because they're not going to move rates until they get it finished. If the ECB is talking more hawkish, Mike, there's a guy on Twitter we both follow, and I just retweeted it, and he had basically the same take as me. I'm going to read it here because it's actually a really good read on what Lagarde is saying, and this particular guy on Twitter is a little bit more EU focused than you are. Alf, Macro Alf is his handle. This is huge from the ECB. It goes to show what I have been saying for months. Central banks will tighten, and hard. That's because a tail risk is materializing for them. Inflation expectations have started to move up in a sticky fashion, and they must act. The Fed is next. Go to the second part of his thread, and he says, I will deliver a thread on the ECB decision after the press conference, but for now, the market reaction is clear. ECB now priced a hike by 75 basis points plus 25 basis points by March 2023. Sharper, flatter yield curves. We've been talking about that. Mike and I have been talking about that in the US for weeks now. Sharper, flatter yield curves, 5s, 30s in Germany's 10 basis points flatter already this morning. BTB's Bund spreads, BTB is the French bond. BTB Bunds spreads, Bunds are German, 15 basis points wider. What all that means is the central banks are in a corner and they need to tighten. To me, this means overall lower equity prices. Still the narrative here. And CPI did not help that at all. At all. Just because it came in where economists were expecting, this is a massive number at 7.9. So that's what I wanted to kind of spew out there.
Yeah. So there we go. I mean, and did you see in Italy's inflation?
Yeah.
I mean, that's through the roof.
It's insane. And Italy has no control over their own economy because like 70% tourism.
Yeah, and it was. I mean, things are not going to get pretty. But again, yeah, inflation's running high. But it ties back to what we started with. We got to trade the patterns and the price action. Longer term.
Hey, can I announce something?
Yeah, sure.
Yes, Coco Lagarde is a philosopher. So a very, very large institution. If you know me, you could probably guess who has asked me to create a podcast with Jim Iurio. Okay. It's going to be called Future's Edge with Jim Iurio. It's going to be his show. I'm going to produce it. I'm going to start as the co-host. And then when we can't book a guest, I'm going to be a frequent guest. I've talked to Jim about Mike. I haven't even talked to Mike about this yet, but I've talked to Jim about Mike having possibly a per podcast, if not an every other podcast, macro technical segment. It'll be futures based, but we'll be able to talk about everything, mainly economic fundamentals. And I want to host it here in Path Trading Partners YouTube. If you guys think it's not a fit, can you let Mike know? I have to produce it, and then with Mike, I'll talk to you about more of the details later. And I have to host it somewhere. And it seems to me like we can jumpstart here if you guys are okay with it. And of course, if Mike agrees, because it's part his channel, part my channel. So
Well,
I'm not going to do anything
there's your
without
quick.
his agreement.
There's your feedback. All right, we're getting some feedback already. Christoph, who's a regular all the time and gives us great information from Europe, thinks.
Yeah.
There you go. Your conversations with Jim were always fantastic from the pure exposure shows. Wavy thinks it's a great idea. Michael, Amit. I mean, we have a good community building here. Yeah, everybody.
Okay.
Yeah.
In which case, Mike, I'll talk to you about like the Discord server and everything else that we can possibly bump things around on. But it's going to be starting in April. It's going to be an hour long once a week. I'm going to try and keep it under an hour. Again, it's going to be hosted by Jimmy, not by me. But it's with an eye toward an entire lineup of podcasts that'll be on this channel. So, and then I'll try and get it on other channels too, like Apple Podcasts and everything else, but I don't even know how to do that yet. So if anybody does know how to do that, reach out to me on Twitter or something, or reach out to Mike.
All right. Well, there we go. Ted says, brilliant. Been looking for a better podcast. So, yeah, we're getting good feedback on that, Bob. Thanks for sharing that with the community. Thanks for coming on this morning. Looks like we're starting to roll over again in the NASDAQ.
Yeah, we're going lower.
So,
by the way, don't trade that.
What?
Don't trade me saying that. I'm not trading me saying that.
You're right now talking. So
I have not put on an equity short. Just so you guys know, I'm just saying it looks to me like we're going lower, but I don't have a pattern to sell right now. So
the key thing I'm still watching is the S&P right here. So I mean, we still have this potential doubles in play. Until that gets invalidated, that's what I'm keying off of.
Right. So do not sell that. I just said we're going lower, please.
Yeah. No, everybody buy because Bob. Don't do anything based off what we say. It's educational purposes only. There, I covered it. And that's the way we're going to end it with.
Oh, wait, this is a family podcast, so I'm going to give you this one.
Okay, yeah, that fixed. No, it's not suitable for kids. I mark every video not suitable for kids because I never know when you're coming on. All right, everybody. I'll
see you guys this afternoon.
I hope everybody. Yeah, well, Bob will be back on this afternoon. Have a great trading day, and I will talk to everyone later. Bye for now.